Hello, and welcome to Launchpad, Rocket Fuel's interview series where we talk to people mostly attached to Rocket Pool somehow, but in crypto in general. Today's episode is actually one that I'm really excited about. I was really excited about, and it was absolutely great. It was with Charles Allen, the CEO of BTCS, that is an Ethereum Treasury company. Charles has a long history with BTCS and watched it change from a Bitcoin online store all the way through to Bitcoin mining, getting listed on the NASDAQ, and then leaning all in on Ethereum 5 years ago, pretty much. So Charles has been around for a while and he's been in Ethereum for a while, but BTCS's name has only really grown popular in the last couple of months because of the proliferation of the ETH treasury companies. So Charles and I talk about how BTCS kind of went across this journey and Charles's journey as well. And we talked a lot about BTCS and Rocket Pool, how they're linked together, and what kind of relationships are happening there. And on top of that, we talked about the kind of things that set BTCS aside from other treasury companies, including how they are leveraging DeFi plays and being builders and relays. So we talked about a whole lot of really exciting things, and I think you'll all find this interview really informative and really educational, and also just really fun. Charles has some really cool stories from being involved in the crypto space so early on, and I'm sure you're all going to really enjoy this. So let's jump straight in.
10, 9, ignition sequence start, 6.
Hi, Charles. It's so nice to see you and to get this chance to talk to you. You must have been a really busy man this last couple of months with everything that's going on. Huge congrats to BTCS on the massive amount of ETH that you guys have accumulated recently. Some of our audience might not be familiar with who you are. So can you tell us a little bit about who you are?
Yeah, so BTCS, we're a publicly traded Ethereum first blockchain infrastructure and digital asset treasury company, and we're executing one of the most sophisticated Ethereum accumulation strategies in the public markets, basically crossing DeFi and TradFi to maximize ETH holdings, and then our operations are vertically integrated across blockchain infrastructure. So we're running solo staking nodes with a staking node operator for Rocket Pool, as well as a block builder, and I guess we have a relay as well. And so we're looking at all sorts of other initiatives on the blockchain infrastructure side, such as integrating with ETH gas and a bunch more.
Yeah, that's so cool. So one of the things that I noticed, I've listened to a couple of your interviews recently, is people don't really know who you are. Like they don't know the Charles behind BTCS. So why don't we find out a little bit about who you are and what your story is? So I heard that you started off with engineering as your background. Like when were you an engineer? What kind of engineer were you? What was going on there?
Yeah, so I mean, if we're gonna start from the beginning, I grew up in Manhattan, so New York City, and when I always loved to build things, right? So if it was model airplanes, radio controlled planes, like from a young age, you name it, I would build it. I even, funny, one time I asked my mom to borrow like a drill. And this is before cordless drills, and she wouldn't let me. So I was like, fine, I'll just go make my own. Went to a Radio Shack, bought a motor. Literally, then I had a cordless drill. I was like drilling through the phone book. So I was kind of a bit of a tangent, but so grew up in New York, studied because of that kind of creativity and build stuff. I studied mechanical engineering at Lehigh. After that, I worked for a compound semiconductor company called MCore. So the company basically sells the capital equipment you use to make tunable lasers, LEDs, et cetera, and spent the better part of about a year and a half traveling on the road. So I was about 1 year living in Asia, Korea, Japan, Taiwan. And then I left MCore after about a year and a half and went to a startup in Santa Barbara called Agility. We were making tunable lasers for the fiber optic industry. And my title was MOCVD engineer, which was, metal organic chemical vapor deposition engineer. So that's kind of, that's what I did in the beginning of my career. And then
Wow.
the internet bubble burst. September 11th happened. So I went back. Basically, there were no jobs. So I decided to go back, got my MBA with a focus on finance. And after that, I went to go work on Wall Street at a boutique investment bank called Broadband Capital Management. I was doing SPACs, pipes, reverse mergers, small cap deals. So, for the better part of 10 years, I kind of worked my way up on Wall Street, albeit at smaller, lesser known firms, but doing really unique, interesting deals. It was kind of like VC type deals in the public market. So very familiar with a lot of these deals that are happening now on the.
Yeah. Yeah, I was just thinking that the kind of tools and mechanisms you just mentioned, and a lot of those are being used right now by like these ETH trust strategy companies, like, getting the pipe deals and all this kind of stuff going through. So that's really, really interesting. Then, you were on Wall Street, I guess, for about 10 years, maybe, before you, yeah, and then before you transitioned to BTCS. Like, you were on Wall Street for a while, and then, like, what happened after, like, you heard about crypto? When did that happen?
You know, a lot of things are just luck in life, right? In 2013, I was working in um, New York City doing investment banking. My wife at the time was a corporate lawyer, and she had gotten a job at BAE Systems, big defense contractor, and it was in DC. So now it was all of a sudden I moved down. I was reverse commuting back to New York, and I kind of decided I didn't really want to do investment banking anymore, and I definitely didn't want to commute, every week. And so I started looking for um, I was really looking for an early stage company where I could come in and get them, come in as like a CFO or, help take them public, something more established than what I ended up with BTCS, but really looking for like, is there an early stage company in Washington, DC that is getting ready to go public, or I could come in and help bring them through that process and then, take a senior role. The reality is there are very few tech startups or, in the DC area. And I was looking to kind of marry my engineering background and like the creativity of build stuff with, um, 10 years of finance and banking, and try to put those together so I wouldn't lose everything I'd spent 10 years doing as a banker, that whole skill set in finance. If I went and did something else, and it's like, well, okay, that I can't leverage that experience. And frankly, I got lucky. It was through I think someone worked for my wife, their boyfriend. I met him at a cocktail party, and he's like, and we kind of got along. And he was in the tech scene in DC. And one day he sends me a term sheet for Bitcoin Shop, which is what BTCS used to be called. We changed the name because the banks were shutting our bank accounts, and so we just one day we're like, we're done with this. Get Bitcoin out of our name. And so he sent me this term sheet. This is back in, I think, the fall of 2013, and the company Bitcoin Shop was basically two guys with a crappy business, if I'm being honest, of an e-commerce site where you could buy stuff with Bitcoin. You could go buy a TV, and all they did was connect to Amazon, buy the product, and reship it to you. But you couldn't spend Bitcoin anywhere else. I think like around the same time, Roger Ver, I don't know, for those familiar with him, they call him Bitcoin Jesus. He had Bitcoin Store. He actually tried to sell us Bitcoin Store, and I told him, I was like, "Thanks, Roger, but I'm looking at other ways we can generate revenue and have a better business in the public markets." But that was kind of the start, and so we went public. I basically got the deal done in about 4 weeks. Initially, the team wasn't sure they wanted to do it, and it's funny. There's probably at that time there's probably two people in DC that knew how to do reverse mergers and pipe financings and these more esoteric type small cap, micro cap deals, and this thing just landed on my lap. So that was luck, right? A couple, life's a lot of luck. If you don't know what decisions you make each day, where that will lead you. And this one led to, a conversation with the co-founders. We sat down, and I think in 2 days, I was like, this is really interesting. I said, look, I'll come on full board. I'll come on the team. You don't need to pay me anything, because they were still working full time. They're two engineers at NASA. And I said, I'll come. I'll get this deal done. I'm going to buy into the company before. I'll give you back the equity if I don't get the deal done, and I'll pay for myself. And that's basically, in 4 weeks, I think I almost doubled the valuation, increased the funding by about twofold. And we closed, I think it was about 4 weeks from introduction to, money in the bank, being a public company. So it was fast.
That sounds like exceptionally fast for TradFi stuff. Did you know what Bitcoin was at that time?
Honestly, at that point, I that's when I started learning about it, because they're like, oh, there's this, internet money. And my first thought was like, this is like a joke. Like, we'll get this thing public. People are liking Bitcoin, and we'll do something. We'll figure it out. And that's when I started to read about it. And I lived through the financial crisis in 2008, and I read the white paper. Like, this actually makes a lot of sense. It was still very early days. I think Bitcoin was like $200 and change, but it made sense. Like, okay, it's out there. Coinbase was around. We actually had Mount money at Mt. Gox in the beginning. We got it out. Like, we looked at it and something, I mean, this is early day, really early days. So like Mt. Gox was the only place you could go. We had money there, and we kind of decided like just something didn't feel right. And so we pulled all our money,
Nice.
which is a really fortunate. And I've had a couple of scenarios like that with, I mean, it's kind of jumping fast for like the Gemini or what is it?
Gemini.
I had money in Gemini and they'd lent to Genesis. And I talked to someone, a guy I know well at Genesis. I'm like, tell me about your counterparty risk and this and that. And I got off the phone. I'm like, nah, I'm out. Like literally like 2 weeks before they blew up, I pulled all my money out. I just got the wrong feeling, but I kind of jumped there. So yeah, that's how I learned about Bitcoin, got into BTCS. And then, that was 11 years ago. So it's been I don't know if I can give you the whole, I know we're only talking for like an hour. I could talk for 5 hours on the history of BTCS.
I'd love to hear it. So BTCS then, it started as Bitcoin shop, basically BTC shop. And, you guys were like reselling, I guess, stuff. So when you came on, like, how did you drive up the revenue 2x? And like, what did you change right away?
So the first thing I did is I realized we had a bad business, and I said we need to either change how the e-commerce works, and so I set the kind of devs on that. It was a pretty big ask, something to differentiate us. That didn't really work out. And then I realized at this point, because we weren't on the NASDAQ, we were on the bulletin board, and investors don't really take you seriously on the bulletin board. You're not institutionalized. You've got retail holders. Most people are going to think, oh, this is a pump and dump scam, and so we didn't have credibility in the public markets because you're, a $15 million market cap bulletin board company. Nobody cares. And we didn't have credibility really in the crypto markets because we weren't deep in that space. So what we did is we started investing in a lot of early stage crypto companies, which they didn't really work out, but it gave us it helped us build very solid relationships within the crypto community in the early days. And these weren't big investments. These were, 150, 250 grand. But I got to meet and know a lot of the big players in the crypto space back in like 2014. And the thought was, hey, maybe we'll invest in some of these and we can do a roll-up strategy where we could kind of have an exchange, an ATM company, a credit card processing company, a wallet. So we invested in a lot of these companies. And that actually worked out really well because through the relationships we built there, fast forward, I think this is like 2015, like CZ, he was on our advisory board.
Nice.
Was on our advisory board. Will O'Brien, who was one of the co-founders of BitGo, was on our advisory board. So we got to know a lot of people of like the OGs of crypto. I mean, now most people have done pretty well, but it was a really unique time to be in the space that early. But we definitely had an uphill battle. The e-commerce didn't work. And so we ended up pivoting and becoming the first public Bitcoin miner. So at the end of 2014, I kind of looked at this and I said, how can you make money in crypto without going to jail? Like, how can you actually generate, this is 2014, like what can you do in this industry that is not going to land you in jail? Or that you need $100 million to do? Like, what can you do that you can incrementally scale, get revenue, and not get in trouble for? And we looked at everything. We looked at, payment processing, being an exchange, there's these regulatory hurdles. And that's when we kind of landed on Bitcoin mining. And so we leaned very hard into mining. We were the first public company to do it and had to figure everything out. We had to figure out the accounting. We had to soup to nuts, figure it all out. And we scaled up pretty fast. We had a 3,000 square foot facility in North Carolina. That was an amazing real estate deal that we cut. We built out to like 3 megawatts. I know these numbers sound teeny, compared to like the big scale mining today.
The hash rate now is like 1,000 times more than it was back then. So
We started buying the equipment. We bought equipment from Bitmain, and then we started buying a lot of equipment from Spinduli's. I don't know if anyone even remembers that name. It was an Israeli ASIC manufacturer, third largest. And the thought was, we're going to vertically integrate with Spinduli's. So, we'll have everything from ASIC chip design to deployment, plus we'll sell as well. We're going to be one of the largest Bitcoin miners. And what really shut us down, I feel really bad for our investors, is we just didn't have access to capital. We were on the bulletin board. We weren't S3 eligible. The SEC would not let us get through with an S1. We spent a year and a half wasting shareholder money and my time answering stupid questions by the SEC, which meant the only financing we could do were pipe financings. Now, a pipe financing, if you're on the NASDAQ, is pretty clean because NASDAQ rules don't allow you to have like anti-dilution protection or all these funky things. And if it's not at the market, you need shareholder approval. So like they don't get done. If you're on the bulletin board, the investors are going to put they're like toxic deals, right? They're going to have full ratchet anti-dilution. They're like nasty VC deals, stuff tied to the stock price. And I think we got the best deals we could when we were on the bulletin board, but it was still, we're on the bulletin board. And where that kind of led to was, in order for us to get this merger done with Spinduli's, we needed to do, it was probably like a $10 or $15 million round. We hired a banker. Everything was ready to go until the SEC just kept blocking us. So we spent a year with the SEC. The private company ran out of money, Spinduli's. And then all of a sudden, by that time, we'd lost the window. So Bitcoin crashed from, I think, like 800 to back to like, around 200-ish. I mean, it's kind of crazy to think about today. And that put the whole mining operation, we hadn't scaled up enough to be profitable. We were making good revenue. I think we had 1,500 Bitcoin at one point. And it seems like there's a lot now. Then it was like, oh man, we got to sell this stuff. And it was like nothing, right? Like we got to sell this and pay the bills. Then we got robbed. Like literally when they shut the electricity off, the facility got, we got physically robbed.
Stole like your mining machines?
Yeah, they stole the mining machines. The best thing that ever happened to us. It's the best thing that ever happened to us because they were insured. We'd done equipment finance and they were insured, and we were just like, we're out, right? So I wish they stole them all, but even that, I mean, hopefully you don't mind me going into some of these kind of
of course not.
history stories. But so on that one, they were convinced it was an inside job. So they did a whole investigation. They thought we stole the machines. I'm like, I didn't steal the machines. Like I'm in DC, the machines are in North Carolina. When we steal them and sell them on eBay, like, come on. So they investigated for like 2 months, like you guys didn't do anything wrong. Like we know. The power company shut the lights off. So now you have a facility in not a great neighborhood in North Carolina where the lights just went out, which means there's no security. And there's, thousands and thousands of dollars of Bitcoin miners. Like someone backed a truck up and stole it all. Police didn't really care. They're like, well, you should have known better than you should cut the lights on.
Yeah.
Anyway, so that was kind of how we got into mining. Fortunately, like and this is what I was saying, that I really feel bad for the shareholders. When we had done a convertible note deal, and when the SEC did not let us get through the registration statement process, we defaulted on that note. It became like a variable price convert, and everybody lost all their money, right? Like they just sold this thing to zero. And then we spent the better part of a year restructuring. I mean, I think there was one part, like there was almost a year, I don't even think I got paid. And then one of our investors, like, you can't make more than 50 grand. I mean, it was kind of, for the company, dark times. I think we got down to like an $800,000 market cap at one point, 2 people. And we just didn't give up. I was like, you know what? This is the stock trades. We'll figure something out in crypto, and kind of scratched my head and said, well,
were the founders still involved then, or had you like kind of taken over at that point?
Two of the So one of the founders is still with us, Michael Hanahan. The other one, Tim City, he left maybe like shortly after the when we got into mining. I don't remember exactly. So, I mean, he was a developer. He was a great guy. Just, when it got small, like there wasn't a great fit. But yeah, so we got into, after the mining, we decided that, we were stupid. If we had not put all this capital into depreciating machines that are at some point going to be paperweights and just bought Bitcoin, we would have crushed it. Right. And so, at that point, it's like, it's too late for that. Bitcoin's at like $2,000 now. And so we did that. We restructured the company. We bought Bitcoin, we bought Ethereum. And that's when I think this is like 2017. Yeah. We basically had a digital asset crypto strategy, right? Treasury strategy, which is what, like, well before Michael Saylor, right? I mean, we were doing this like early days, but just on a very small scale. And I remember I was talking to one investor, and they're like, I don't know about this, buying these cryptos. This just sounds crazy. And I got really lucky. Sometimes you need someone with a big name that people are going to trust to give credibility to your strategy. And I forget, there was an article on CoinDesk that came out. It was one of the Coinbase guys started some fund, was it Polymath or Poly something? I forget. It was a long time ago. And it was our strategy. Literally, I'd put this in a pitch deck, filed it with the SEC, and a couple of days later, this thing, I didn't know idea this is going to come out, comes out on CoinDesk. I sent it to the investor, like, this is our strategy. He's like, oh my God, Andreessen Horowitz just put in this deal, we're in. Right? And I was like, okay. So That kind of got us on a trajectory. They didn't put a lot of money in, and we just chipped away at it for, a couple years, thinking, okay, well, if we're, Bitcoin was around like 2,000-3,000, Ethereum was about between 200 and 300, and we were kind of 50-50 with Bitcoin and Ethereum. We had some other tokens, but the SEC basically said, explain to us why these tokens aren't securities. And we said, our response was basically, we've sold them all. We don't have to answer the question anymore. It's an impossible question. There's no, like, with Ethereum and Bitcoin, we can kind of get there because we could be like, well, Jay Clayton said it wasn't on TV, so you said it wasn't. Is it or is it not? And they were kind of like, they back off on Ethereum and Bitcoin. I mean, just recently, it's like, God, how many, 8 years later, they finally admitted that Ethereum is not a security. But you could not access the capital markets if you had any of these tokens that were on your balance sheet then.
Let's take a tiny step back. So that, if we go back to like 2015 or 2014 even, like, had you heard about Ethereum and like the white paper and all that kind of stuff? Like, what kind of stuff were you hearing about Ethereum back then?
So we were actually, in 2015, we were mining in Ethereum at a very small scale. So Bitcoin was our big mining operation, but we bought a couple of GPUs. And so we were actually mining Ethereum. I think it was like $6 and it cost us about $3 to get. We didn't do it at scale. It was more kind of like a side project experiment for fun. The reason is, with the Bitcoin miner, we had a big data center, and there's old videos of this on our website, which are pretty cool. I go back and look at those, and it's, very nostalgic. But you could just buy a Bitcoin mining machine, put it in a traditional server rack, plug it in the wall. You'd have PDUs that, the little 220 that you plug a bunch of the miners into, it go to like, another big one, and you were done. With Ethereum, you're basically, back then, you're running it on a GPU, so you're building a computer. It's like, wait, so I'm going to buy a GPU card, and I got to get on a motherboard. What motherboard support multiple cards? It's like, this is not scalable. We're not going to have like a bunch of guys sitting around like plugging GPUs in. There were no off-the-shelf GPU miners, and so it was not a scalable business model until manufacturers were going to come out and start making GPU-based miners. So yeah, I mean, that's what I learned about Ethereum. At that point, it was kind of early days. It was more like, here's another token. It's really big. It's second to Bitcoin. Let's focus on it. I think it was probably about 20, maybe, and the dates are kind of a bit fuzzy here. It's been so long. Maybe like 2020, 2019, we started to get I started to really start looking at Ethereum in a different way. It actually reminded me of, for anyone that's been in the space for a while, colored coins. This was, I think, in 2016. Yeah, it was a 20. Yeah. And I remember I was at a conference, and I saw the whole presentation. I'm like, this is amazing. I'm like, but there's no way this is going to work. Was my thought. Like, these guys are, this is a massive project. They're not going to get adoption, but it could change. Like, the concept that really resonated when I saw the first colored coin presentation. And I think, Ethereum has done what that was supposed to do. And for anyone watching that don't know what colored coins are, it's basically, Bitcoin or Ethereum, that token's a fungible token, and a colored coin would be a non-fungible token. I'm not talking about the monkey smoking the cigar that sells for $5 million, or I don't know why it does that, but whatever. I'm talking about just that each token can be unique. It could be a ticket to a concert. It could be your car title. It could be a secure, like, the possibilities are endless in terms of how you tokenize real world assets and make them move on a global scale. And that's to me what resonated when I first saw color coins. And then when I saw, when I really started studying Ethereum, like, this is interesting. This is much more. And we actually sold all of our Bitcoin, did a dividend in Bitcoin, which was the first. We called it the dividend, and went. It was fun. It's actually a blockchain dividend because it could be done, other tokens beyond just Bitcoin. It was kind of like, why are we? I didn't see a business model around Bitcoin. Right? Not that I want to knock Bitcoin, but like, it doesn't do anything. It's you stick it in your wallet and you hope it goes up. Most people are hoarding it and not spending it. And so, like, what are we doing as a public company that can actually grow a real business around this? I mean, turns out Michael Saylor figured out how to do that. But again, even I look at, like, all he's doing, like, really, he can't do DeFi with that. All he's doing is these funky preferreds, and it's just, capital markets magic. And he's pretty good at it. And he's got investors to buy into it, but like, there's no economy. You're not going to build an economy. It's not the base layer of a world economy. It is an asset.
Yeah. So when in like the 2015 time and then going forward to like 2017, like when you told people that, hey, look, I work for a Bitcoin company, like a Bitcoin mining company, how did people respond to that? And how did you find that changing over the years?
Oh, people think you're a crook or you're a criminal, right? Like, oh, that's the money for drug dealers, right? And you're like, oh my God. Like, I think my wife, we go to a cocktail party, don't talk about it. So, and having grown up in Manhattan, a big swath of my friends work on Wall Street. And I would tell them, like, and they're just like, "Ugh, what is this guy doing? And so now it's super exciting to see it actually come to a point where, and I look, it's beyond Bitcoin, right? Like Bitcoin was a first generation blockchain that proved that you can actually have you can eliminate trusted third parties and have real world, tokenized assets and have them move on a global scale. And so, but yeah, I mean, it was back to your question. 2015, it was really hard, right? You tell people, what you do, and their first thought was he's involved with the drug dealers, right? Because you had Silk Road happening then. We actually had an interesting story. The Silk Road, what was the guy's name behind it? Why is his name slipping my mind?
The Red Robert Baron,
Yeah,
yes, sorry, Pirate Dread Roberts. I
yeah,
think
yeah,
something
yeah,
like that. Yeah, I forgot his real name.
exactly. So the agents that took him down went rogue,
Yeah, that's
right?
right. Yeah, I remember that. Yeah,
Carl Force and I forget the other guy's name. They actually I'm pretty sure they tried to blackmail us. So I think it was around 2015, 2016. They showed up at our COO's door. We bought some mining equipment that was shipped in from Israel, or maybe it was China. It was Bitmain or some dealers. I don't remember which one. And so they showed up at his door at like 6 o'clock with guns and badges and like interrogate him. And he called me up after. He's like, "What do I do?" I'm like, "You tell him the truth." And they were asking about what we did, where we got the miners, what they're for. They asked about. They saw we were invested in some other companies. Started asking about those companies so that they could start. And then they started investigating those companies, the ones we invested in. Like GoCoin was a payment processor, and we later found out that they weren't really investigating us. They were trying to find dirt on us to blackmail us. And the way we found that out was this article. I happened to get asked to be on Bloomberg West, like the TV show, and to talk about these guys getting in trouble. And they didn't know that when I got asked to be on the show, that they had actually come to our COO's house and tried to start getting, get information to blackmail us. And so I ended up going on the show and we talk about it, and he asked the question, like, yeah, these guys literally like showed up at my COO's door and when he was in his PJs and were like grilling him. I was lucky. My wife was like the number 2 lawyer at BAE Systems, a big defense contractor. So this, the head of security sat right next to her. And Chen's like, you got to talk to, the head of security. So I talked to him like, look, these guys, the FBI agent showed up. I was like, okay, I'll get you in touch with the FBI, and gave me the cell phone of a pretty high up agent over at the FBI. So I call this guy and I'm like, hey, this is what happened. And he's like, oh, okay, and he got me up to another higher up that was like on the case. And so I spent like 30 minutes on the phone talking to this guy. He's like, oh yeah, these guys are definitely trying to rob you. He's like, I'm like, well, what do you need? I want to testify. Like these guys should go to jail. He's like, you don't quite have enough evidence, but he's like, I can't really say any more than that, but don't worry. Which was pretty cool. Like, and they did get in trouble. I forget what they did. Like one of them got caught trying to flee and they did like 7 years, but it really is a sign of how bad the government was towards crypto. Either the SEC was trying to put you out of business. The banks were shutting your bank accounts, which really wasn't the banks. It was, the administration pressuring the banks to not do business with certain industries, crypto, payday lending. And then you even had agents that were like, let me go blackmail these guys because they're a bad industry and they can't do anything. They're probably doing something wrong. Yeah, which 10 years later, we know that's not the case. It's one of the most compelling technological innovations of probably be of my lifetime, right? I mean, it's like the internet, AI, crypto. I wouldn't even drones, not so much. I mean, it's cool, but not
yeah.
as good as the others.
And then how did it change in 2017 then? Like when crypto was kind of booming and like, we were hitting all-time high prices, did that kind of, like, was your phone blowing up and people trying to get in touch with you and trying to find out like how they could get into this crypto thing?
No, I mean, 2017 was a really interesting time. It's just when some of the big Bitcoin miners started to take off. And so we were in an interesting spot. We didn't have a lot of money. I mean, I think we had like $7 million at the time. And I was actually working on, at that time, 2 M&A deals. So the investors in the investors that seeded BTCS in 2014 went on to fund and found Marathon
Oh,
and Riot. So I know those guys really well. One of them unfortunately got in trouble with the SEC. And so when and I gave both of those. I mean, I gave them a turnkey business model. So I was also for a short stint. I took over as the CEO of this company, Global Bit Ventures. We raised about $7 million, and it was going to merge with Mara. And you can go look this up in the file. Like if you look at their S4 filed with the SEC in 2017, I was supposed to take over as CEO, and I was comfortable doing that, leaving BTCS because I wasn't going to leave BTCS high and dry. So at the same time, BTCS was I was in negotiations with BitBuy, which is now the Canadian exchange under WonderFi, which now is got bought by Robinhood. So they were at that point like a 7-person team, and BTCS was going to merge with BitBuy. And so that deal, in connection with that deal, I wasn't going to be able to stay on as CEO. So I would have stayed on the board, but like one of the conditions to that is like they wanted to lead the show. And so I was like, this is great. Like, I mean, I couldn't believe it. I'm like 2017, I'm like, I'm going to close 2 massive M&A deals at the same time. I'm going to leave BTCS in great hands. Plus I get to keep my equity, and I'm going to go be CEO of Mara. And I got to, it's like, I'm going to crush it. I mean, I was working hard. I mean, this is like, and then unfortunately, one of the investors got in trouble with the SEC, canceled the deal, which it worked out okay. Global Bit had a 12% break fee, but then BitBuy canceled the deal as well. And so that meant the BitBuy deal we'd never announced. BTCS, we never announced that we'd signed, a binding LOI. It's not required. If there's no break fee, you don't have to put out an 8K. We had the deal fall apart with Spinduli's. And I was like, I don't want to put out anything. Like, I want to put it out when it's done. I don't want to have like 2 failed deals on my resume. Turns out it was 3, but whatever. No, with this, I mean, that's part of M&A, right? Like sometimes it works, sometimes it doesn't. Yeah. And so at that point, we kind of, and it's good. I mean, this is one of these things that like luck, like you don't know where things will take you. And so with both of those deals off the table, it's like, okay, well, what are we going to do as BTCS? We looked at a couple other deals that didn't come to fruition. And, that's when we started really looking at like, okay, we've got the Treasury strategy and levering up to do that, but we're doing it on a very small scale and we're unnoticed. And this is really around the time we started looking at Ethereum. And I think it was like around 2020, I think it was around 2020, we pivoted pretty much all in on Ethereum. So we got rid of our Bitcoin. And again, all these dates, just for everybody that's watching this is 11 years of history. I'm doing it off the top of my head. I didn't go like check dates and stuff. So I could be off by a year or two.
it's fine. It's totally fine. But that was a good time to swap into Ethereum, though. That was like really low ratios for BTC to ETH. So that was a nice trade.
Yeah. So, but it was still small scale. And so we started doing that with, basically went all in on Ethereum. And then we wanted to start at the end of 2020. We really wanted to start staking Ethereum. It launched, I think it was
December 2020.
December, I forget when in December. We opted not to do that. And we started in the first quarter of 2021, primarily because if we started then, we would have to account for staking revenue in 2020. And our auditors had never seen DeFi. They'd actually told us, like, if you get into DeFi, you can't be your auditor. Right? I mean, literally, okay. And no other auditor would touch the stuff with a 10-foot pole, right? Well, this isn't DeFi, this is staking. And they're like, yeah, it was one of those like, okay, we'll wait. If we do it in January, then we have to wait till that quarter ends. So we have to March 31st, and then we got 45 days. So all of a sudden you have months and months to figure this out. So we've done all the planning, got them ready to be like, we're going into staking. Here are the memos. Here's how it works. Here's how you're going to account for it. Because they hadn't done this. Like nobody had done this. I mean, now auditors actually, I talked to an auditor, I forget what, one of the large firms, they're actually running validator nodes so that they have a full copy of the blockchain so that when they audit their clients' transactions, it's not using a third-party service, which creates major issues for audit firms. So they're actually auditing against their own data, which is syncing with the network.
Pretty cool.
That's relatively recently. You go back to like 2020, and we're like, it's hard. I mean, even my on the audit question, I remember my first conversation, we had Markham as our auditor. We were mining Bitcoin, and because we were the first to do this, 2014, they're like, well, if you're a public company and you say, I have, $100 million in the bank account, the auditor's assumption is you're a liar, right? Prove it. And they're not going to ask you. They're going to go directly to the bank. They're going to go to JP Morgan Chase. They're going to choose and be like, show me, this is the guy's account number. Does he have $100 million? Is that actually his account number? They're going to go, yes. Okay, that's audited. If you tell them you have revenue, they're going to go to your customers and verify that if you say the revenue came, that indeed they bought these products as said. They don't do every single transaction. It's at least select some. So it's statistically significant. They have their whole procedures. But in 2014, we told Morgan, like, well, who do we send the confirm to that you got the revenue for Bitcoin mining? I'm like, well, we run a machine that connects to a network, and the network is a decentralized network of other computers. It's built into the protocol, and the protocol gives you both transaction fees and block rewards. So, like, what's the physical mailing address that I send the confirmation letter to? There's no letter. They're like, okay, what's the email address? There's no email. Like, who do I send to them? Like, there are no freaking people. There are no people. It's a computer network. There are no people. I'm sorry. Like, if you don't like that, every quarter we would go through this discussion, like every single quarter. So, that was like the stuff we were living through, which is why like getting into DeFi was not like, hey, this is going to be easy. We're just going to, go do some swaps on Uniswap, and then we're going to borrow against it on Aave. And, like in 2020, that was not something that you could account for.
So when you started staking, obviously the beacon chain went live and there were no withdrawals, right? Like it was just locked. It was a one-way street. Like
Yeah, it was.
and there was no way to get your ETH out either, right? Like the rewards that you were getting. So how did you kind of explain this to your investors and shareholders about what was happening? Like what were people thinking?
Well, you assume people even understand crypto at all, right? Even today, I've had conversations with shareholders, and they're like, they just like I see the blockchain, they don't know what that is. It's like, okay, well, how do I explain? Like, you just have to keep dialing back and back to like, oh my god,
Yeah.
it's a 6-hour phone call. Like, I don't have. You need to go take a class. I don't have time for this. So, we just followed gap guidelines, right? Our auditor looked at it. I don't know if it was like I may have showed up as restricted. A restricted asset because it has a maturity of over a year. Most investors didn't really understand that if the beacon chain, and we disclosed this, but like if it didn't merge, we were out. We were full in on this thing.
Yeah.
And it was just a risk we took. So we're a crypto company. We're betting ETH. Like, if this works, we're in super early. So we did that, and it worked. Not thankfully. We would have been, we wouldn't be here today if that. Ethereum wouldn't be here today if that had gone sideways. So
Yeah.
we were willing. Yeah, we're I think the only public company. God, we've been the only until like a couple months ago. We're the only public company with like ETH operations on its balance sheet. I think there were a couple others that had some, but like pretty much it's been us for the better part of 5 years. And that was a risky bet. That was when we took that bet of we're going to go in on the beacon chain. We can't get our rewards. We can't pull it out. If it doesn't work, we're out of luck.
Yeah. Wow, that was I can imagine, like, for someone like me, I started staking a little bit later than you guys on the first week of January 2022. I'm home node operator, and I was fine, right? Like I was just like, yeah, I trust these devs, they're gonna be totally okay. But we're talking like a whole different level of play here, right? Like, so that I can totally imagine how that might have been stressful for you all for a while there. But thankfully it all went quite well. Like the merge was a huge success.
Yeah.
Were you guys just sticking with ETH staking then at that time, or were you exploring other strategies, or like were you still trying to find other ways of getting revenue?
At that point, ETH was, I think, 75% of our assets. We were looking at other ways to get revenue, so we did, and we've kind of moved away from this. We were looking at it more from a traditional standpoint that like we love ETH, we're going to go, that's the major asset, but like the revenue was low because it's just based on yield. So if you have $100 million, and I'm just using round numbers here, you make 4%, you have $4 million in revenue. Like, that's not all that exciting. And so we looked at it and we said, well, how do we make money off other people's money? And so we had a staking as a service platform. And if you think of the big ones, you've got like, a Figment or a Kiln or Stake. There's all these platforms that do it. We were very slow to market on that platform, primarily because of regulatory concerns. The SEC was like the biggest viewer of our website. What we ended up doing was we decided we weren't going to do any custodial staking. Kraken got fined $25 million for doing that. And I was actually talking to Dave Ripley the other day. I've known since like 2014. It was like, they paid a fine. They probably should have fought it. I know Coinbase fought a lot of things. And we had a press release years ago about this where we kind of tried to lay this out. This was a press release that was not geared to investors. This press release was specifically geared just for the SEC. Like, SEC, please go read this. Here's our analysis. Here's custodial staking, which we don't do. And then there's non-custodial staking. And Ethereum's a proof of stake blockchain, not a delegated proof of stake blockchain. So you can't do that with Ethereum unless you do like a liquid staking token, which in my mind that is hands down a security, which now I guess, with the new SEC proven wrong. With the old SEC,
we'll come back to that later, but
yeah, we'll come back to that. And so we structured our business to be 100% like it was Ethereum for our own book. You can't stake your ETH with us. We're not offering any solutions there. And then we ran validator nodes for other blockchains, which were delegated proof of stake, like Cosmos. Because we're like, look, if you run the node, once you kind of have one infrastructure, you do this. If people want to delegate to your node, you get a piece of that fee. This is great. It turns out if you're not one of the first movers in that space, it's very hard to break in. We didn't have kind of the team to expand. Once you start adding all these tokens, you almost need a whole team for each token because you got to keep up with that blockchain. And then we didn't offer any liquid or custodial staking. We were in the US, so others were doing custodial staking. And we looked at it like, it just didn't really pick up. And so we've basically been getting rid of, we shut down, I forget when we disclosed we shut down, we called it Stake Seeker. We basically shut down Stake Seeker, which, I mean, frankly, the funny part is the whole staking as a service. It's because that's what we called it, because people would understand that. It really wasn't what it was. It was we run nodes that people can delegate to, and we have a nice website where you can connect to those nodes and track your rewards. But it's an informational website because we don't actually allow trading. And then the node's a different business. Because of our entry into that business, I mean, we had a full-blown SEC investigation. They basically said or believed that we were a broker-dealer, that we were offering unregistered securities to the markets. And the funny thing is we actually went to the SEC, it was the Office of Crypto Hub or whatever they were calling that thing, and did a whole presentation and a memo and said, we think delegated proof of stake is not a security, but if we were debating, this is why we were slow, we were debating taking the rewards and then paying those rewards out to the users so we could KYC them so we wouldn't have an OFAC issue. So we're really like, okay, we're either going to deal with OFAC if they want to pick an bone with us because we take rewards and then pay them out, or that may create a securities issue. So we went to the SEC and we said, okay, we want to do it this way. Thankfully, they didn't give us the answer. And then, of course, shortly after going to the SEC and asking for advice, they did a full-blown investigation on why it was a security when they wouldn't give us an answer. I mean, that was kind of how they operated,
that was actually going to be one of my questions about, Gary Gensler's famous line, just come in and talk to us. And the joke kind of about, the sad joke being that anyone who did go in and talk to them was then investigated by them. Like, it seemed like such a horrible environment for you guys to be like operating in. How was that in that time? Like, when you were trying to get the staking service going and like, your own staking, your own capital as well. Like, what kind of conversations were you guys having with the SEC? I know you just kind of alluded to that a little bit, but maybe you can go explain a bit more.
Over the last 10 years, it's been it's just a disaster. I mean, the SEC, in my mind, has cost our shareholders tens of millions of dollars by not doing their job, right? I mean, the SEC's job is the formation of capital and the protection of investors. That is 100% their mission. So the protection of investors is you have to stop people from fraud. You have to make sure people's disclosure is accurate, so investors are making informed investment decisions based on information. And then, the formation of capital is like you need to and you should promote companies being able to access the capital from investors. If you block their access to capital because you don't like their industry, you've broken the law, right? And if you are, going after them or basically stonewalling them when they try to register, like it's a violation of their mission. And they did this for 10 years, and this was like day one. And what was it? when we first went public, it was pretty bad. I mean, it took over a year to get a registration statement effective. They would just keep asking questions. They would never let it go through. And I think we've probably filed more registration statements than any other public company. We've probably filed 40, 50, 60 of these things, including amendments. And so, it was always a battle. We had one where we, after about, it was getting close to a year and a half, we pulled this thing called the delayed amendment. And I spoke to a lot of law firms about this. So the way it used to work is you would, like a long time ago, you would file a registration statement and 20 days later it would automatically be effective. And there were so few companies, that's how it worked. Everyone would just file these things. And if the SEC wanted to look at it, they would, but 20 days is plenty of time because there weren't that many. And instead of having like a congressional change of the rules, basically what they did is they did a Band-Aid where you put this thing called the delaying amendment on the front cover. And if you have this there, it says, that you're going to delay so that there can be further comments. It's just a paragraph that sits on the front page. And there's actually a really interesting Wall Street Journal article on this when the government shut down, where the SEC advised companies to remove the delaying amendment because the government was going to be shut and they weren't going to be able to review these. And so I forget this is, at least 5+ years ago, because I don't remember exactly when, we were stuck with the SEC for about a year, and we removed the delaying amendment and filed a new copy of the prospectus. And then 20 days later, we waited our period, we filed a final prospectus, and we were effective because the SEC, they couldn't do anything. And at this point, if they wanted to stop us from selling securities to the market, they would have needed to do a stop order. And I read every single stop order on the SEC's website. There's there's not that many, like 15, 20 of them that I reviewed over the last couple of years. And this is like, you are a blatant criminal. And so our view is, it's been almost a year and a half of answering SEC questions. We're trying to comply with their disclosure. How could they say that, the statements that we put in that registration statement after a year and a half are false and misleading, and for the protection of investors, they have to stop the sale of securities into the public markets? And that was basically our approach: is let's go to court, and you're going to explain to a judge how, the stacks of questions we've been answering for the last year and a half are false and misleading. Because if you can't do that, then we're through. And that kind of broke the logjam. And it was funny. I learned a lot about how the SEC worked then. So, because I spoke to our counsel, was like, you can't do this. They're going to fine you. They're going to come after you personally. They're like, you're going to get the war machine. They have unlimited capital. You can't fight the SEC. And I talked to 3 other law firms, and they're like, dude, if you do this, you're an idiot. Like, they're going to destroy you. And I basically said, fuck these people, right? Like, we're doing it. And what I learned is, the examiners are, you get assigned like an examiner group. It's not like you're going to the highest people. And so examiners have the ability to approve or not approve stuff. But they didn't want to approve anything crypto related because they didn't want to tell their boss why they approved this crypto thing. And the boss didn't want to tell their boss. And it all goes back to the chairman, right? Chairman doesn't want anything to do with this. And so it was kind of like, you don't touch this stuff. And what you would do is just stonewall these companies till they go away. You can't get through. So at some point they give up. I mean, what they didn't realize is, I will never give up, right? Like, we're the oldest, public company in the world for a reason, public crypto company. And once we did that, it put them in a box, because now some junior guy is going to have to explain to his boss why this, sub 50 million market cap company is dragging him to court over this thing. And now it's going to be a big deal. Now it's going to be a really big deal. And so when faced with that, they just let him go. I mean, I think that's what happened. That's my anticipation of what happened. And we literally did this. We had to do this again. We didn't end up having to pull the delaying amendment and file it. But the last S3 we had an S3 that was worth, it was $100 million. And that was put in place under the I guess, not this Trump administration, the prior one. And then when that expired, we tried to do a new one for $250 million. And that went effective at the beginning of this year. But we were 1 year in registration. We got down for half a year, we were down to 6 immaterial comments. This is like dot your I's, cross your T's, like stuff that like they wouldn't even ask, like they shouldn't be asking. And they would, usually your lawyers call the SEC. I started calling the SEC, and I would get them on the phone and be like, they're like, this is important. I'm like, no, it's not. It's been a year. Tell me how this is, how you're fulfilling your mission. She's like, no, it's important. I'll let the other people know, because it's a government, like there's tons of people. And finally, I sent an email. I actually posted the email on X, and I basically called them out and said, we pulled the delayed amendment in the past, kind of alluding to we're ready to do it again. Tell us what you want to disclose, and we'll do it. Like 2 days later, we were effective. And it was just like, okay, well, we shouldn't have had to do that. We shouldn't have had to do that. They should have. Now, I'd say the new administration is amazing. Like we filed another shelf registration statement, no comment. Literally no comment. We're done in a week.
Yeah, that's amazing.
It's nice. It's really nice to have, a government agency actually, doing their job, providing, guidance on what the rules of the road are, and not trying to put you out of business is kind of nice, right? Because that actually harms shareholders when, you can't grow a business if the government's trying to put you out of business, right? And if you're a retail shareholder in a small company and the government's trying to put that company out of business, like, you can blame me that, well, the stock didn't do well, you didn't grow it. Like, well, I spent my time dealing with the government.
Yeah. Okay, so you guys were staking. How did you find Rocket Pool?
So we were, maybe it was 2 years ago, we were really looking at how do we grow revenue beyond just what we're doing, right? Solo staking nodes is great. And to kind of give you background, like when we first started staking, we had a third-party group that helped us launch because we were a small team, and we're like, well, let's go to some experts, bring them and help do it. But it's still solo staking under us. We weren't outsourcing it to a Figment. And then that was for about a year. After about a year of that, we got good at it. We hired some more people. Like, well, we'll bring this in house. So we stopped using a third-party service. Then after that, we started, because we brought it in house, looking at like, what else can we do? Like, let's we hired some more people. I think you probably spoke with Ben Hunter, our VP of engineering. So we've grown the team. We've got more developers now, and we really started looking like, how do we get more yield? How do we generate more revenue? What are the tools out there? And Rocket Pool was one of them. We looked at a couple others. So we looked at Statter. Running their documentation was not really. I think we ran like 1 or 2 nodes, very small amount of capital. It was pretty much unauditable. The efforts our CFO had to go through to be able to show to our auditor that like, this is the revenue, that we can account for it. When we looked at Rocket Pool, I mean, frankly, at the time, the economics were a little bit better on Statter. We looked at Rocket Pool like, this is just so much better. It's bigger. There's a bigger community. The documentation is great. We can audit this, and we're going to get, I think it's anywhere between 30 and 40% increase on your staking reward. I was like, well, why wouldn't we do that? And I guess everybody watching, like all of your audience probably understands like how that works. But like, if you're buying a liquid staking token, you're paying a fee on that because someone else is running the validator, and you're basically splitting your reward with the operators behind that. And so since Rocket Pool doesn't actually run the nodes, that's outsourced, by running the node, we get to split the fee on the staking rewards that are not our ETH. And so for us, I mean, I looked at them like, this is just like staking as a service we were doing before. We're running the nodes, but we don't take the risk. Let's let Rocket Pool issue the security, because I was convinced, I mean, this is the analysis we did. If we're a node operator for someone that is issuing a liquid token and that token's a security, do we have regulatory risk? And we came to the conclusion of, we're not issuing the security. We have nothing to do with it. We are just a service provider, and we were comfortable with that. So,
was there any risk of like commingling of funds on your servers with like OFAC sanctioned entities or anything like that?
We've spent a lot of time on the OFAC stuff. So that's actually how our relay got started. So right now we have a relay that we run on Rocket Pool, and where our relay is, we call it OFAC Plus. So one of the things we did, because it's not just the SEC you have to deal with, right? There's all these other regulatory bodies. And so with no guidance from any of them, right? Because OFAC gave a little bit, but it was Bitcoin mining, and, it was unclear. Then you had the whole Tornado Cash stuff. So, we looked at this as like, we're, apart from the Bitcoin miners, until recently, we were pretty much the only US public company doing anything creative in crypto, right? And we're still with what we're doing with Aave and a lot of other things. We're still pretty much on the leading edge, at least for public companies. I know there's a lot of private companies that are doing super creative and super cool stuff in DeFi and crypto, but like aren't really auditable, aren't coming through. So back to your question, like, we looked seriously at OFAC. Our builder would screen out addresses for wallet addresses that were on the OFAC list. I believe we still do that. We actually went a step further because our concern was, well, what if one of the addresses on the OFAC list does business with someone and they're tangentially connected? Maybe they're in Tornado Cash. So we actually partnered with Forta and built a database that, or they were kind of using their database to lever it to say, okay, look, these are the transactions that we should not be involved with. And I know a lot of people hate this because they're like, well, it's censoring. It's, you're not following the ethos of Ethereum. Like, I'm keeping myself out of jail. How about that? And I'm keeping the company and I'm protecting our shareholders by, abiding by the law, which at that point was unclear. So you had to be super conservative. Now I feel like there's, as this regulatory clarity comes, you can actually say, okay, I'm allowed to do this and I'm not going to get in trouble for this. Before it was like, well, that's a gray area, and they're going to get you if you go in there. So don't go in that box, don't go in this box, don't go in this box, and like lock everything down, which makes it really hard to be, innovative and grow. But yeah, so we dealt with the OFAC. That was part of our relay. That was part of our builder, which actually slows things down. When you have to do all sorts of checks that your competitors aren't doing in screening, you actually end up with you have to design your systems to be better so that they can account for that speed decrease.
Yeah. And one of the things that was really cool recently that we saw was, you have this relay and you were blocking Tornado Cash transactions from that, which, I totally understand where you're coming from. But once it was pointed out to, I think it was Benjamin, one of the people in the Rocket Pool community, was like, hey, like, you don't have to do this anymore. Like, why are you doing this? Like, it's not a FinCEN guidance anymore. And like, oh yeah, we don't have to do that anymore. And then within days, like that was like, greenlit from the relay and the builder. Like that was just really cool to see that responsiveness from you guys.
Yeah. I mean, there was a reason we did it in the beginning. I'm pretty sure, I'm 99% sure we're still doing the OFAC base list. I think,
of course. Yeah.
like we're not.
Yeah. No, not like all of it. Just that segment of it is what I mean.
Yeah, exactly. But it comes back to like how we operate. There's certain risks we're willing to take. Like we were willing to put all our ETH on the beacon chain pre-merge. We're not, and I probably have PTCSD from PTSD from dealing with the regulators, but we're just not going to take a regulatory risk. It's going to put us in hot water. And so that's why I think that's really why we even started a relay in the first place, right? Is that the other relays that we looked at on Rocket Pool, and I know which ones are there. Like you have the
Beaver Builder.
has one, but that's just OFAC. And it was like, well, that's not good enough, right? It may be great for them because they're private and they're not under a microscope. But so yeah, that's literally the only reason we started building a relay was so that we could be OFAC compliant. That's how that started.
Yeah, that's so interesting. So staking with Rocket Pool, how's that experience been?
It's been great. I mean, I think the thing we're just waiting for now is the Saturn upgrade. So I think I've sent this in another forum where I think we're more skewed in terms of our ETH to solo validators now, substantially more. And a big reason there is the queue to get in and out of Rocket Pool is much longer. And so if you have to exit the queue to come back in for Saturn, like there's just too much waiting time for us to go in, out, just like back, forth is just like not productive. So I think we're probably paused now in terms of a Rocket Pool deployment until the upgrade.
Yeah.
Not to say we don't like Rocket Pool. It's just like we just
it's
sitting in queues. It's like having we want our ETH generating. So if it's 30 days in, 30 days out, and then by the time we get it in, we're taking it out to put it back in. It's like okay, there's like a whole quarter it's not generating. Versus solos you can get out really fast, so we can get we can unbind our solo nodes really fast. So when Saturn comes, we'll just pull some off the solos and throw them in.
Makes sense. Yeah, that's interesting. So I guess then the next big development was this idea of like the ETH treasury company and like, the digital asset treasury companies that kind of emerged over the last few months. Of course, we as the crypto community only saw like, this huge explosion just happening on the scene. But this is, I'm sure, something that you guys have been working on for quite a while. Like, can you tell me, like, I guess technically BTCS was a crypto treasury company for a while, like many years. What's changed? Like what kind of conversations have been happening in the last few months? Like how's that been?
Well, I think in terms of us, like nothing's really changed. Like our business has fundamentally not changed in the last 5 years. We've kind of gotten better and better and expanded. The reality is the digital asset treasury strategy is really a byproduct of our operations, where for all these other companies, it is like all they're doing, right? You throw a bunch of ETH in a biotech company and hope it goes up and stake it with galaxy. Like that's great. And, I'm sure they'll get more sophisticated over time. We've kind of been doing this for a while. I think what we leaned into is like our messaging didn't work for Wall Street. If you look at our pitch decks, it was, well, here's how block building works. It's all this complicated flow charts, and nobody gets it. Nobody gets it. And so we kind of dumbed it down. I think we finally got it right. And we said like the most sophisticated, DeFi, TradFi, ETH accumulation flywheel, right? Or however we're calling it, where you basically say, okay, we're going to, raise capital through the ATM. We're going to raise capital with above market convertible debt, which is actually really hard to get, but we're managing to do it. And we're going to, raise money on Aave, which is right now it's a net, it's a positive. There's no cost of capital. We're actually getting paid to, put our ETH up as collateral. We're making a net positive return and providing like a leveraged exposure as a company. So you do all that, and then you've got like the side flywheel of, the operations, block building on one side and the validator node ops on the other. And so like Builder Plus is our block building and node ops is, our validation. Under node ops, you've got Rocket Pool and you've got solo nodes, and we're looking at all sorts of other ways we can maximize there. And so, I think it's great that all these other digital asset treasury strategies have come to play, especially on Ethereum. I couldn't be happier that we've got, Joe Lubin, who created one of the co-founders of Ethereum, is now in the public markets telling the Ethereum story. You've got Tom Lee telling the story. And frankly, it makes my life so much easier. Like now I don't need to explain Ethereum. We have we've got a new investor presentation coming out soon, but we're going to have one slide on Ethereum. Like these guys are doing a great job telling the story. This is what differentiates BTCS. We've been doing this forever. We're bullish on Ethereum. We're bullish on like how it's going to, enable the tokenization of real world assets on a global scale. But our operations have been around for 5 years, and we're kind of leaning into these things that I think we're ahead. But it's been great. I mean, all these guys coming to markets added credibility. If you're the first one to do something, you don't have credibility, even if you're a big name. Once everybody starts piling in, it's a credible strategy. And so now what we're doing is looked at as a credible strategy. And because all these big guys came in, it literally helped us. It like catapulted us from where we were stuck for the better part of 2-3 years at like between $1 and $1.50 stock. Maybe we go up to $2 or drop below $1. And once you're below $1, you're like, oh my God, am I going to be here for 30 days? And now I got to, I got to think about a reverse split because of the NASDAQ rules. To, the stock started trading massive volume. We were prepared. We had that 250 million shelf, and we've raised, I think in the last couple of months, 207 million. So that's after, Q2 end. So, like any of our results that'll come out next week aren't even going to include what it could with what the impact of that funding, which even for Q3, it's kind of coming throughout the quarter. So we're really setting up for like a good, Q2 is going to be good. Q3 should be good. Q4 should be better, right? Because now we're actually doing this at scale. And to do, I think any of these strategies to truly work, you need to be at scale. And we were always struggling. I mean, I was happy. We were like, okay, we have, anywhere between $30 and $40 million, and that's not bad for a NASDAQ company. But like at that level, it's all retail holders. Institutions can't buy your stock. Your stock, good day would trade $1 million, but you don't have access to the same capital that the big guys would, and institutions won't touch you. Now we're in the Russell Microcap Index that adds liquidity. So there's a lot of liquidity in the stock, which means we have access to capital, which means we can grow the business.
That's really exciting. And you guys recently got approved for a $2 billion shelf. You said that the process took a week. How's things with the SEC now?
I mean, like it's amazing. It's night and day. It's really night and day. Apart from the process of filing the shelf, they basically gave us a no review, which is great. I mean, I would have been upset if they gave us a review because we've been filing for 5 years. Like, what questions could they possibly have that we haven't already answered? Yeah, I mean, I think just the statements coming out of the SEC, they're giving clarity on so many things, which are going to allow institutions and more people to come in. But to your point, like on the 2 billion shelf, getting it was easy. We still have like 105 million on the previous shelf. It was just one of these, if the stock runs up, trades huge volume at a big price, we want to be able to capitalize that.
Yeah.
And there was literally I think it was like a 2-week period. We were raising, $10 million a day, 20 million. I mean, it's a decent amount of work to process this, but we would, when you raise it, we immediately deploy it, and then the kind of the whole machine starts spinning where that becomes the focus. So it's actually been kind of nice to have. I don't really like where the stock price is today. I think as we put in our last press release, our last big sales, I think we raised 30 million at 790 a share, and now we're at like 4 and change. And I think most people see this $2 billion shelf. They're like, here comes the dilution machine. These guys are going to dilute this. Largest shareholder, zero interest in doing that. We're not going to be the largest player. I mean, maybe over time, but right now, SBET and with Joe and Tom Lee with BitMiner, like they're huge, right? Like for us to catch, the only way we catch up with them is to blow up the whole company and just dilute it, the hell out of it. And I have no interest in doing that. The shareholders, including myself. And so, that 2 billion shelf's good for 3 years. So we have 3 years to raise that, and then it expires. And if the administration is still reasonable, we could put up a new one for, in a week. I mean, I debated doing $100 billion shelf just so that, people will be like, okay, obviously not going to raise $100 billion,
Yeah.
right? Like, because you don't need to use the whole thing. We didn't do that is because you get fees on how much you register. So you have to pay SEC and FINRA fees based on the dollar amount you can raise. So it's like, and then the auditors will charge you based on the dollar amount you have raised. So it's like, if you pay the auditor, 200 grand for a sign off on a 2 billion, and you want to do 100 billion because you think it's going to, people won't like worry that like obviously that's not serious and you're not going to dilute that hard. You're going to pay like $1 million or I don't know what it is. It just gets expensive. So
10 million.
Yeah, I mean, we did our first shelf was it expired at the end of last year, and it was 100 million shelf, and I think we only sold 17 million off the ATM, and we did a registered direct. So we raised 27 million in total over 3 years on 100 million shelf. Over 3 years, we've had the market change. So we've raised 105 on a 250 in kind of short order. But just because we have a 2 billion doesn't mean we're necessarily going to use it. If the market's good, we could, but it's not like 2 billion equals these guys are going to just dump. And I know some people are doing that, right? Like, there's definitely a race going on for the top 2 spots on the leaderboard, and we're not going to play that game. We'll raise, but we'll raise in a smart way.
What kind of things do you wish that investors like paid more attention to instead of just like the stock price?
I'd say the operations, like what we're actually doing, and this is something we're trying to articulate. Like, if you look at the ways you can get exposure to ETH that are from the public markets, assuming we're going to stay off chain, you have an ETF, which is basically 1-to-1 with low fees. Then you have the digital asset treasury strategies, which is a 1-to-1 plus staking. Typically, they're paying a third party to do the staking with fees, and they may add debt and they may do some other things. And then the third is kind of where we're at, where I think others will emerge, but where we're at is kind of like the 1+1 plus the staking, but with no fees, plus the block building, plus the rocket pool, plus the plus. Like, how many pluses do we have to add before investors get it? The problem is most investors are like, I hear crypto's hot. Like, at least on the retail side, they're like, crypto's hot. How do I get in? What are the plays? Like, go with the biggest guy.
Yep.
Okay. And our deck is historically been kind of complicated. We're trying to simplify how we tell the story and not get too technical. Our focus is also pretty big on growing revenue, right? I think the market understands a company with big growing revenue. So if we can lead on revenue generation, even if the kind of margin is lower, and focus on margins in the future, hopefully, investors and the street understand that.
Yeah. So one of the strategies that you guys are using that I've not seen anyone else use is this Aave play that you're doing. Can you explain like to the audience a little bit of what it is that you're actually doing with Aave? Because most people have heard of Aave, like it's the biggest TVL protocol in crypto, over $50 billion of assets in there. But I don't think people really understand how it works. Like, not like my audience, I think a lot of them do understand how it works and they've used Aave, but like, how are you guys using Aave and what's going on there?
So I think that the simplest is kind of walk you through let's call it a week in the life of BTCS using with fundraising coming in. So let's say we raised $100 million on the ATM, and maybe the convertible above market note, but 100 million of fiat comes in the door of BTCS, and this is just an example, not exact numbers.
Yeah, I understand.
So we take that 100 million, we go buy ETH. The next thing we do with that ETH is we're going to say, okay, let's let's get leverage on it. So we deposit it all in Aave, right? So we take the ETH, we post it as collateral. Now we've got the collateral in the protocol, and we can borrow against it. So if we put up 100, let's say we borrowed, for simple math, we borrowed $30 million in USDT. And this is actually amazing. Like, I've had bankers call me and be like, I can help you get a loan, I can help you do this. And it's like, and I'll kind of get back to what they asked for, but so now we borrowed this 30 million, and it's a variable interest rate, but historically it tends to float around, a little bit below 4, a little bit above 5. You can see spikes. We could borrow Go, which is a stable coin by Aave, which we've looked at. That's more of a fixed interest rate, and it's adjusted by the DAO over time versus like a market-based interest rate. But right now, the rate to borrow USDT is very low. So for simple math, let's say we borrowed at a 5%. We borrowed 30 million at 5%. That means we're paying $1.5 million a year in interest, and it's perpetual. It's not like this comes due like a mortgage on your house. It's a 20-year fixed or something, or 30-year fixed. It's like it's forever, and it just keeps accumulating and accumulating. And in order to draw out our collateral, we've got to pay off that loan. And so now we're earning 1.5 million on the 30 million we borrowed, but the collateral we posted, let's just say it fluctuates, it's variable, but let's just say that makes 2 million. I have $100 million in ETH, and that's in ETH, so we still have the exposure to ETH, and we're generating 2% yield in ETH on that collateral. So if we just kind of fix the price and say, well, what does that look like? So that's $2 million in yield we're getting from posting our 100 million, and we have to pay, because we borrowed 30, we've got to pay 1.5, right, at 5%. So net, we're making 500 grand a year, right, on 100 million posted, and we've got another 30 million in USDT. So we take that 30 million, we go buy more ETH with it. Now we're using DeFi to buy it. We're not going back to OTC desks. We're using like CowSwap or Uniswap or DeFi, decentralized exchanges do that, because frankly, some of the best rates you can get. So now you've got another 30 million in exposure to ETH, which we didn't have to dilute our shareholders to get. So no dilution, plus it's yielding. So we're making a positive return. There's zero cost of capital, assuming things don't change in the variable rates. And then we take that and we deploy that at 30 and we stake on it. So we stake that to either solo nodes, or we can put it in Rocket Pool where we're kind of compounding. And that helps, all the other infrastructure operations we're doing. So no, I don't think really anybody else is doing this. And there's a lot more levers to pull, things we could do within DeFi to start improving that beyond what we're doing. And we're looking at them. In order to do them, we need to make sure we can account for them. So that tends to be our slow process of, but before we got into block building, we spent 9 months. We spent a couple months with our auditor around it. We spent 9 months with the SEC going around accounting stuff. With Rocket Pool, same thing. We made sure our auditors would be comfortable with how we would account for it. With Aave, same thing. Are we going to be able to account for this? Are we going to be able to prove the interest we got on the collateral is auditable? Are we going to be able to prove the interest we owe on the borrow is going to be accountable? So this is, our process is very different than like, someone that's got their, Ledger or their MetaMask wallet, and like, let me throw, $100 in this thing, and they don't need to worry about any of that stuff. So
yeah. So one of the things that we mentioned earlier that I think is a good time to bring up right now is the SEC changing their ruling this week, or their guidance this week, about LSTs, which is liquid staking tokens. So the idea is like, you deposit your ETH into Rocket Pool, you get our ETH in return for that. That ETH then goes to a node operator, like, to mingle with their ETH and become a validator basically, and you pay a commission, and then you keep the rest of the rewards yourself. So you were saying like, you had historically thought that this was a security, a vehicle, but now the SEC is saying this is not a security vehicle. How is that going to change your analysis? That I should just add, a lot of people in the Rocket Pool community think that instead of depositing raw ETH into Aave, what you could do instead is mint our ETH basically with that $100 million, then take that $100 million and then put that into Aave instead, because you're still earning like a 2.5% yield on that instead of the reward that you're getting from Aave instead. And then with that, you can borrow the USDT and use that in other things. Like how has that changed the analysis? Basically, the SEC's changing policy.
It's a huge change. I mean, it basically opens the door up for us to look at more ways to, maximize revenue, increase yield, where in the past we couldn't. And I'll kind of explain like why it's a big deal. The Rocket Pool ETH we looked at and we said, well, it's definitely a security. In my mind, it was definitely a security, right? Under the old Howey test, right? You're buying it with the expectation of profits because it has a yield, right? So okay, it's an investment of money, and it's by the efforts of others, right? Whether that's a DAO or whatever. And I looked at that, I'm like, I can't get there, especially with how the SEC had positioned it. And so for us, holding a bunch of rocket pools a problem until like yesterday, right? And the same thing for, if we looked at Lido staked ETH, right? Like that wouldn't work. Like all of these were like, these are off limits because as a public company, if more than 40% of your assets are held in a security, excluding cash, you become something called an investment company. You have to file under the Securities Act of 1940. And what that basically means is now you're not reporting like income and like the things you're used to reporting, like that we're good at doing and used to doing, you don't do anymore. You're reporting the NAV of your assets. Your audit's different. Everything's different. Like you just change the whole structure of your company. You actually get a mulligan on this. Like if you inadvertently become a 40 Act company, you can say, oh, we screwed up, and the board can do a resolution, and you've got like a year to solve it. But we literally that was the biggest issue we dealt with the SEC for the better part of 2 years, is tell us why you're not an investment company. And I mean, there's like 50 pages of responses we would file as to why we're not an investment company. Well, one, we're an investment company if Ethereum's a security. It's a security. Well, we won't tell you that. Well, I'm like, okay, so it's like round and round. We did all these tests. And so up until yesterday, if someone had said, would you put this, would you buy a liquid staking token? I'd be like, no. I mean, we could buy a little bit because we're allowed to hold securities, but like, could we have done anything at scale? Absolutely not. Does that mean we're going to go do this tomorrow? Probably not. We've got a lot of things on the roadmap. So everything kind of comes down to, for a team our size, how do we balance, what we want to do next? What's going to be the most impactful? How do we spend our time? But it's something that now, of the things we look at, we've got a lot more optionality. So I think it's super exciting. I think it's for the whole Rocket Pool community and for Rocket Pool, I mean, it is a massive win, right? It didn't, from our perspective before this, it was like, well, we love Rocket Pool, but like, if they want to go issue securities, that's on them. That's not, like, that's not our risk. Now it's like, you guys are off the hook too, right? So it's pretty exciting.
Yeah, the possibilities for Rocket Pool have changed a lot, right? Because it means that now Treasury companies can hold our ETH. And not only that, but it opens up the path for our ETH being included in ETFs potentially, in the next wave of ETFs that can come through. There's already a lot of push happening from crypto, like protocols like Jito. The person there, Rebecca, someone I'm forgetting her name, has been doing a lot of like lobbying of the SEC to kind of change their rules on LSTs, and with the idea of this potentially being included in ETFs later as well. So it really does, I think, change the playing field quite a lot. I think the messaging out of the Rocket Pool community is already kind of shifting that, this is a path forward now for huge growth for Rocket Pool, because Rocket Pool has these qualities, right, that kind of set it aside from other protocols. And, it's like decentralized and like all those Ethereum qualities that you want, like trustless and permissionless and one of the best cohorts of stakers that you can have. All of these really great things now, I think it gives us a chance to kind of let them shine in a different way from what we were doing before. So it's definitely like a really exciting time for Rocket Pool and other staking providers too. But I think it's going to take like maybe, a few weeks or months for people to really just understand how things have changed and what kind of things are possible now. It's really cool.
No, I mean, I am so excited, right? It's such a big change that now you can think about other ways to grow. Who else can use the platform? I mean, Rocket Pool was kind of operating under a cloud of uncertainty, right? As were we, but I mean, that cloud's now lifted. So it's definitely exciting times. So yeah, it's good timing for this too. I mean, if if we'd been having this conversation, a little bit earlier in the week, we wouldn't be able to talk
Yeah,
about this.
we wouldn't have, I would have been like, yeah, why don't you guys use our ETH? And you'd be like, well, we can use a tiny bit, but that's it. But now it's like, hey, like, the whole strategy could change. And the good thing is as well that like Rocket Pool currently doesn't have the capacity to actually absorb like, $100 million worth of our ETH. But in 3 months' time, October 29th, with Saturn 1 going through, we will absolutely be at that position where if you wanted $100 million of our ETH, you could get it like right then and there. So that's actually a really, really exciting thing as well. So, we're just going to get that much bigger. So it's really
No,
cool.
100% agree. I mean, that's one of the things we've looked at with Rocket Pool is if we want to deploy, especially with Saturn coming out, and you don't have to put up as much, like, I mean, we now have enough capital to be like, we are Rocket Pool, right? Like, and we don't want that, right? Like,
Yeah, 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 yeah,
there needs to be a lot of other validators in there. And so, I mean, that's something we've looked at. Like, there's only so much we could scale. We kind of joked about it, and like months ago, like, wow, we could never be a huge part. We're so small. Now I'm like, oh my god, like if we were to scale and Rocket Pool wasn't, it would be hard for us to scale, collectively together. I think now with the cloud lifted with the new regulation, for us, we'll probably stay on like the node operator side. But if there's more demand, and that's why the queue's long, right? Because you've got to match. If we and we could literally, and we've looked at that, but like, well, what if we put 50 million in Rocket Pool and we don't have to put the full 50 up because of the scaling effect? Like, we're going to be in the queue for a year. Like, that doesn't work.
yeah,
We are the queue, right?
yeah,
Which is, and I think if the demand comes because of the new regulation, all of a sudden you're like, okay, look, we can deploy more on this, and we're not gonna be the only one in the queue, which would really suck. I mean, that would not be good if you looked at like, hey, I want to run a node for Rocket Pool, and you looked at the queue and like, oh, BTCS has it backed up for the next year. Yeah,
yeah. That's the reason why we need the RETH demand, and like really need, like, as a community, that's what one of the main things that we're working on now is just making RETH the best possible product. We've got updates that we're working on in terms of helping the node supply grow, and we've done a really good job on that, and that's going to come in with Saturn, and then with Saturn 2 even more so. But some of the things that we're working on now is just making RETH a better experience. So the community and the team are working on redeeming your RETH protocol value. That doesn't happen at the moment. Like, in certain situations, there's no way to go to the protocol and say, hey, I want my ETH back. The idea is, if there's some ETH in the deposit pool, you can burn that and take your ETH back, or you go on the secondary market and buy your ETH back, and that has slippage and, like, the peg and all that kind of stuff. Those become issues. But with that one change, of being able to get your ETH back at the protocol rate, I think that's going to make our ETH an even better product as well. So these are the kind of things that we're working on that I think will really help Rocket Pool level up in the next 3 to 6 months. It's going to be a really exciting time. And if it becomes a better product for people like BTCS and whoever else wants it, it's permissionless, right? Anyone can mint it. I think it's going to be really good fun. For crypto as general, like, this is a really, really exciting time, because so many things that we thought weren't possible are now, like, changing completely. The rules of the game have shifted very, very much so, and and yeah, you guys are kind of pushing the limits of that. It's really cool.
no, it's exciting. I've been waiting like a decade for this, like grinding it out, and finally, it's like, oh wait, you can do this. Oh, that's not a secure. Okay, that's helpful. That's not secure. We do something there, and so, and it's across the board. I mean, I think even though I know there's like a bunch of other companies coming to market doing ETH, like I think a rising tide is gonna lift all ships, right? Where if the institutional interest comes in, whether that's in Aave, whether it's in Rocket Pool, whether it's in us, whether it's in Aspirations, as that flows in and all these products are made, because now you have clarity that, if you're using Rocket Pool, I can't, I'm not touching, that's the security, right? Now it's not. Now institutions can come in. It's just gonna, the possibilities of the things you can do when you start to expand beyond traditional systems and move into permissionless blockchains and DeFi and all the stuff built on Ethereum. I mean, it really is, I'd say bigger than the internet. All the internet did was basically digitize information and allow it to move globally, at light speed. Now you can tokenize real world assets, and you can move them globally, 365 days a year, with no trusted third party, with near no fees. And you can build all sorts of businesses and applications around that. And now you're actually allowed to do that. The government isn't going to try to throw you in jail or put you out of business for trying to innovate there. And I think as the clarity continues to come, money's going to flow, applications are going to get built, and for all the people that are not deep in crypto, like, well, I don't understand how or what Ethereum is. Like, you won't even know. Honestly, you may get to a point where you don't even know that you're using Ethereum, or you may be using a product at your bank if you're not on chain that uses Rocket Pool, and that's the back end. So like the whole back end system has the ability to change. I think the front end is going to be harder because the incumbent players have all the relationships with the customers. But when they switch over, you'll have customers that are going to pay a fee to use they'll pay a fee to the legacy players to use the new systems, and then you'll have the up and comers, which is like my kids' generation and the likes, that will just skip the old brick and mortar type institutions altogether and just be on chain. Like, well, why do I need this intermediary in between me and the protocol when I can use that? And I think that's the stepping stone. I think that's why all these banks are freaking out. Why all these, they're all leaning into this because they see that coming. They either need to adopt these rails and figure out, and they'll charge a big fee in the beginning with new rails, make a bunch of money, and then the fee's going to get compressed because everybody's going to start doing it. And I think that'll be the interesting thing. And then it'll be like the internet. Nobody knows how it works. It just works, right? Nobody knows why their Uber shows up. You just order it on your phone.
Yeah.
There'll be all sorts of cool products.
I think it's going to happen really quickly as well. Like, I think 3 to 5 years time, it's going to change completely. And on the back end, at least, like you said, they're already like jumping in. And I don't know like how much you're plugged into like crypto Twitter kind of like discourse, but there's a person called Benji who's working with the Ethereum Foundation right now on the enterprise team, and just in the last month they've taken literally hundreds of calls from the companies, banks, governments. And the question now isn't what is Ethereum? The question is, how do we integrate Ethereum into what we're doing? And I really do think that this is an incredibly exciting time for Ethereum. Like, I'm one of those people who's like just so bullish on Ethereum and crypto. Ethereum, especially, like I'm a self-proclaimed ETH maxi. How do you think that's going to work out? Do you think that the Ethereum's building like these like Lindy effects and like the Metcalfe's law and all this kind of stuff is going to start playing a bigger and bigger role as institutions come in? Like, what are they looking at when they want to adopt crypto or go onto crypto rails?
I think it's definitely coming. I mean, I wouldn't say I'm a ETH maxi. I'm more of a blockchain maxi that
That's fine. Yeah.
thinks ETH is probably going to. I'm highly bullish on ETH. I mean, we run an ETH
Yeah.
company,
Yeah.
but I do like other cryptos. Like Chainlink's a great one, right? It has the oracles have a lot of use cases. Where I think when I think about ETH, why I think it's going to be the winner, and maybe winner is the wrong word. I think a lot will be there, but why it's going to be the number one smart contract based platform. Not that it already is, but like because it's got name brand recognition, institution. It's been up for 10 years, right? Like there's other blockchains that may be faster, but it's like, oh, you were down for a day 2 years ago, and you keep innovating so fast and like keeps breaking. Like you can't build a system on a test net, right? Like you can't build products and solutions that go down. I mean, that's what I love about Ethereum. It's never been down. It just works. Is it as fast as others? No, but it's never been down. And if it can upgrade to be faster over time and it's slower, the amount of upgrades on Ethereum compared to like Bitcoin are like, it's like night and day, right? Bitcoin barely ever updates. So in that sense, I'm, when I'll put on a ETH maxi hat, like I'm like right now, 100% believe Ethereum is going to be what is the rails of tokenization of kind of real world assets. But if that happens in 3 to 5 years, we'll see. I mean, it takes a long time for institutions to adopt, but if it becomes what I think it will, the price is not going to be 3,000-4,000. I mean, it's like because you're going to need to, you're going to need to use it for gas fees, and it's going to generate substantial, value for the world. So, I mean, I would think it's probably 10,000 by the end of the year. Maybe 8 to 10,000 is probably where I put it by the end of the year. If the interest is assuming there's no major issues in the world, I mean, beyond that, I mean, it could be substantially higher.
Great. How do you think about the price now? Because the price is so fundamentally important to the value of the shares that you guys have and the MNAV and stuff. Do you find that you're thinking about the price more now than you used to, or is that still kind of the way it's always been?
I mean, for the last, was it 4 years, we've had this slide in our deck, and I realize it's probably too complicated for most people to understand when we basically show all of our capital raises over a quarter and with um, the MNAV. It's really kind of an MNAV, but it was we used. I mean, this is before the kind of concept of MNAV came out. It was really like a price to an enterprise value to book value and like where we were raising capital. And so when I look at the price, I mean, if ETH's 10,000 and we're 100, like okay, so ETH basically a little bit more than doubled, and we went up, like 10x plus. Like okay, it doesn't matter what the price. Like I think there's an arbitrage there which we can capture. When I think about the price, it matters relative to our stock, and I guess you say really the MNAV. Like I do look at that. I don't think that's the best metric to value a company at because like right now we're below MNAV, and people are looking at us like we're trading at a discount. But like, wait, we've got all these businesses we've built. Like if you took an early stage startup company with our operations, you'd say, well, that's a $10 or $15 million or $20 million pre-money value based on your revenue. Even not profitable companies. Like look at a biotech company. You take a biotech company that's in phase 1 or 2 development of a drug. Phase 2 is probably pretty far off. Phase 1 development, and they're going to get a 50 million valuation and pull in 10, 15 million bucks. No revenue. It's a bunch of guys working on a plan that may or may not work, right? Like so when I look at like the valuations of these companies and even the competitors too, it's kind of crazy that I guess if they're just buying ETH and that's the only plan and staking it, like okay, I get it. You should probably pay a premium to MNAV because you can add debt, you can lever up, you can do a couple other things, you got some yields better than ETF. If you look at us, I know there's a couple others that are starting to work on this where we actually have operations that are like rapidly growing revenue and doing other things. That metric really makes no sense, right? Like if you look at traditional equity metrics, you could look at a price to sales, EV to EBITDA, all of the PEG ratio. When you start looking at all of those, like everyone's honed in on this one metric, and all the institutions have honed in on it, which is unfortunately like we've kind of leaned into that narrative because people can get it and understand, but we're trying to separate ourselves. Like, there's a lot more here. But yeah, back to your original question, like we do look at that in terms of capital raising. Like when we're below, it's dilutive. There's no point, and there is definitely a volatility between our stock and like how our stock performs relative to Ethereum. It's highly correlated, but there's a lot of volatility and they can go other ways. I've talked to a lot of like there's a lot of things that can be done, right? Investors are playing a lot of games, especially in the public markets. You have options, you have shorts, you have it's a much more dynamic market than I think on chain.
Yeah, that's interesting. So, what do you see then for the next couple of years for BTCS in terms of how you have this shelf $2 billion like that you can or can't take out? Like it's up to you guys how you want to approach that. But what do you think the next couple of years are going to look like for this digital asset treasury company like space or for BTCS specifically?
Well, I think everybody in the space is going to do well, and I say that because I'm really bullish on Ethereum, right? Like in my heart, like I see its use cases being so obvious that when people don't get it, it's kind of like I scratch my head like how can you not see how this is going to change the world? So from that perspective, I see the price of ETH doing very well, right? I mean, it's probably 8 to 10,000 by the end of the year, I would hope, and I could go far beyond that in the not too distant future. I mean, just look at what's happened to Bitcoin. So on the east side, I'm bullish, and that'll make all the companies do well. So any company that decides to lean into ETH, I mean, if I'm right on that assessment, everybody's going to do well. And then it's just a question of, well, do others do on a relative basis better than their peers? And I think that'll come to, well, have they had better capital allocation, right? What kind of financings are they doing? Are they using DeFi? And that's where we kind of want to kind of shine. Like, can we really drive revenue? Can we drive more value than just, holding ETH? And that's why it was kind of you can get an ETF that's it's a 1-to-1. You can get a pure treasury that's, ETF plus staking. And then there's us. And that's where we're trying to develop all these things so that we have a really compelling investment thesis. So if we're right on ETH, I hope we are, and we're able to pull some of these off, I think that's where we would kind of, stand apart from the other players.
Yeah, and just to wrap things up, Charles, how has your life changed these last few months, like for you personally?
I mean, I'm working 18, 20 hours a day, so I'm barely sleeping. Um, but to work 10 years to get to a point where like, there's an opportunity to seize where we've raised 207 million in short order, put it to work, are growing. Like now is the time. Like I didn't fight the SEC for 10 years to get like simple stuff done to miss this opportunity. So, I mean, if you look like even the little, turtles in the background, like I think about 3 years ago, I came up, I was like, I'd love to build $1 billion company, right? It's a unicorn. If you're $1 billion company, you're a unicorn. It's more so in the VC market. And I kind of looked at it like, well, it's taking us forever, and we're 11 years at this already. I mean, it's all going to happen. Hopefully, it happens, in short order. But and so I came up with like the turtle corn across a unicorn and a turtle because the turtle and the hare, race. I was like, we're the turtle corn. So it's exciting, right? Like we've got more projects and efforts than we really have time for. So we're trying to prioritize. But I think it's probably the most exciting time in the company's 11-year history.
Yeah, it's so amazing to think about like how you've worked so hard over the years, and now you are at the point where you can kind of just be like, yeah, I did it, and let other people take over. But you're just like, no, this is what I've been working for, and I want to keep building, and I want to keep developing and growing. And I think that's really commendable. Like, it's really, really cool that you still have that motivation and that fire to keep growing, for yourself and for your shareholders, and for so many people now in the Rocket Pool community who have bought BTCS shares. So we're all in it together.
No, that's super cool. I mean, like, I'll tell you, it was a couple weeks ago. We were just selling a lot on the ATM, and it was like a Friday. We sold I think $30 million at 790. And I remember it was like, okay, and it was kind of crazy because these big days, the market opens at like 4 or 5 in the morning, or it's stupid early. So you got to like you're up for that, and then close in like 8:30. And after that day, we closed at 790. We kicked off a convertible note deal, and that's a lot of paperwork. That's a lot of processes, a lot of negotiation. We literally worked all weekend, and it was a small deal, $10 million. Like most people could have been like, you raised $30 million today, go and enjoy the weekend with your family. Like, no, no, no. Like, I know this investor will be there if I call him up, and so we banged out a $10 million deal over the weekend. Worked the whole weekend, and had it announced on Monday, and we had raised it was a convert with a $13 conversion price and an $8 strike price on the warrants. So, I mean, that's like 42% savings on dilution compared to, the ATM. And it was frankly a lot of work. I mean, the only thing that annoyed me is my family trust put in for like 50K. And I was like really irritated. Like I have zero control over it, but they had a participation right because they were in the last round for 200 and I put in 100 in the last one. And I couldn't say like you can't do it. They have a right. And I'm just like, man, for 50, like at that point I was like, for 50 grand, like this is so much paperwork. Like, I didn't say something like, there's a trustee, I don't control it. I'm obviously a beneficiary, but I was really irritated. I wish they hadn't done it because it was like, you know, 4 more hours of work for 50 grand. I mean, I'll work hard, but like, after burning it on all ends, it was like one thing to go from the 30 to the 10. Now for the 50, it's like, but yeah, I mean, it was interesting. So anyway, I rambled on a little bit there, but just some.
It's totally fine. Yeah, is there anything that we should have covered that we didn't cover?
I don't think so. I mean, look, usually when I'm on some of these, they're shorter calls. So I really appreciate having a more in depth call that has some fun background and stories. So really appreciate you having me on.
Yeah, I really appreciate you giving the time, because this is, like I said, one of the most exciting things in Ethereum right now, and it's something that's got so much attention. And the fact that you guys have such a great relationship with Rocket Pool just meant that this had to happen. So I'm really glad that we were able to do it, Charles. Thank you for your time.
Yeah, thank you so much.